this is a good time to emphasize liquidity because you see continued downside ahead. And this is where I've been trying to take the conversation this whole time is once the capitulation event has happened, there very well may be an amazingly good time to deploy capital. And we have seen that moment of opportunity happen at the end of down cycles at previous points in history, at previous points in your investing career, Ted. And I really want to talk about that opportunity in just a second. But is what I said, did I, on a broad basis, correctly capture how you're looking at things?
Oh, totally. You know, I think people, for the first time ever, too, I've said this, you know, use it in speeches a lot, that savings is back. I mean, you can have short-term money now and make, 4.5% on it. And that hasn't happened in a long, long time. So why get too overly aggressive right here and try to guess these things out?
Titled Liquidity Makes a Difference, which shows basically the following 12-month returns after major market bottoms. Can you just speak to that briefly? Because I want folks to understand the size of the magnitude of the potential opportunity here for folks that take the prudent course and build up dry capital and have it available to deploy at these key moments.
I think people, for the first time ever, too, I've said this, use it in speeches a lot, that savings is back. I mean, you can have short-term money now and make, 4.5% on it. And that hasn't happened in a long, long time. So why get too overly aggressive right here and try to guess these things out? Let it play itself out. You're not, even if you miss 5% off the low, it's okay. You'll still be in great shape. But the opportunity there that you mentioned, there'll be some really good opportunity, I think, at some point.
All right, great. So you put up a chart in your investor. Liquidity makes a difference, which shows basically the following 12-month returns after major market bottoms. Can you just speak to that briefly? Because I want folks to understand the size of the magnitude of the potential opportunity here for folks that take the prudent course and build up dry capital and have it available to deploy at these key moments.
And I guess everybody has to run money the way they felt like they should do it. And for us, one of the things we've always been, our best years have always been off market lows, 03, 09. And what happens is, and some people go a different direction. You'll find there's flavors of money management, okay? Some managers are really good in a bull market and they just, they run off and leave everybody and then they just give it all back in a down market. That's not like what we like to do, okay? We, as the markets go to extreme highs, and they were extreme highs and really for 3 years almost there, we like to start to cut back on that so we can create liquidity, and we just keep creating more and more and more. Now, we run the risk, I'll just tell you internally, we run the risk of losing some business because somebody can walk in and say, well, you're not staying up with the S&P 500. Well, you know what? I don't want to. And the reason I don't, because things are really expensive. So obviously we're not, because we're raising cash. And so, but we still make good money. But then when you get into the low side, if you have a lot of liquidity, that's where you really make up the difference. And I try to tell this to people. I said, don't worry about every single year so much, but know where you can really pick up a lot of territory. And that's off the low. If you can pick up 50, 60% off the low in that first year or 15, 18 months, that goes a long way to making a portfolio look great over the next 5 years. And that's all we've tried to mention to people. And also the flip side is true. If you can keep from losing a lot of money at the high, even though you don't have liquidity, that also helps you out too. Those two extremes really help you out, so that when you get into these periods where it's steady market for 4 or 5 years, you may not do as well or, as you might want to, but you're doing okay. But where you make it up is those extremes. And I think that's what people have to realize. How do you know how to work the extremes? We've tried to run the kind of portfolio that after these really rough periods, that within 18 to 24 months, we're back at a new high in the portfolio. Now, the only way you can do that is to have liquidity. And I would say personally, I'm probably overly conservative. I grew up quite poor. And so I have a problem in going backwards and losing money because it takes too much to make it. And I find that this idea that don't worry about losing it because it'll be okay in the long run. Well, we do worry about losing it,
Right.
you know, because you're losing it. Okay. And so this idea that just don't worry about it, it'll be okay 20 years from now doesn't really fly too well with Oxbow, but that's our firm. For the first time in many years, really, you can get 4.5% on your liquid money. You know, we have probably, we have billions of dollars in over $1 billion, I know, in the floating rate U.S. Treasury, floating rate. Okay, that means you can't, the principal's not moving up or down. I think we're up to about 460 today or 465, pays quarterly. I mean, you can afford to wait. I mean, did you make 4.5% last year? That's my question.
Exactly.
So if you didn't, why worry about a 4 or 5 days in the early part of the year where the market moved up a little bit? Why don't you carry that liquidity, see where that takes you, and you've got plenty of time. Like I say, you can you can make a low in stocks and miss the first 5 or 6, 7, 8%, and you'll be just fine. If you look at most people on the advising side of the business that are, say, under 35, I'm going to use that as an example, or maybe under 38 or 40, you will find very few of them are carrying really high cash levels. And that's because of the extent of what they've experienced the last 13 or 14 years. They haven't had to do that. So naturally, that's how they grew up. And Wall Street will stay zealous like that. They will. They'll keep saying, buy the stocks, don't let it throw you off. Keep on buying. And they'll buy that all the way through to the low. And then you'll see some reports that say, hey, well, you might want to cut back on this one or that one. They're usually on the wrong side. I've watched Wall Street for decades, and they're typically on the wrong side of the trade. And I still think they're on the wrong side of this one. I think the hardest thing in Wall Street is this, and you'll notice this with strategists, analysts, investment advisors, that sort of thing. It's very hard for them not to be in the group. If all of a sudden they're doing something that puts them out here alone and it's contra, it's almost impossible for that group to do that. They just can't do it. Now, they can keep their jobs by being, in the middle of the pack. They can do that. But is it really good for the investor? And so I think what people have to realize is that most of what goes on today in the big investment banks comes from the top. Most of the quote unquote wealth managers you see at these really big investment firms, they're not calling that shot. That's coming from somewhere else. And so, walk into one of these firms one time and just say, why'd you buy that stock? See if they can tell you. And that's what we always tell everybody. And I think that's what you have to keep in mind, especially during a tough time.